Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sprouts Farmers Market Inc. Annual Report. Sprouts Farmers Market offers a wide range of businesses and services that cater to customers seeking healthy and organic food options. At the core of their operations are their retail stores, which provide customers with access to fresh produce, meat, seafood, dairy alternatives, and other grocery items. In addition to their retail stores, Sprouts also offers various lifestyle-friendly ingredients such as organic, plant-based, keto, paleo, non-GMO, and gluten-free products. This includes a variety of categories including bulk items, frozen foods, beer and wine, and natural health and body care products. The company's product offerings are diverse and cater to different customer needs and preferences. They provide customers with the convenience of shopping for all their grocery needs under one brand, making it an attractive option for those seeking healthy and organic food options. The recent crash in Sprouts Farmers Market, Inc.'s SFM stock price can be attributed to several key factors. One major contributor is the company's cautious financial outlook for 2026. Despite reporting strong results for 2025, with a 14% increase in net sales and a 42% rise in diluted earnings per share, Sprouts projected a challenging start to 2026. The company anticipates comparable store sales to decline between 1% and 3% in the first quarter of 2026, a sharp contrast to the 11.7% growth seen in the same period last year. For the full fiscal year 2026, Sprouts expects comparable store sales to be flat to slightly negative, ranging from -1% to +1%. This deceleration from the 7.3% comparable store sales growth achieved in 2025 has raised concerns among investors. Another factor contributing to the stock's decline is EBIT margin pressure. Management forecasted a decrease of approximately 85 basis points in the first quarter of 2026, largely due to fixed cost deleverage and the impact of its loyalty program. Additionally, the company acknowledged a slowdown in comparable store sales momentum towards the end of 2025, attributing it to broader macroeconomic pressures and consumers facing challenges due to high grocery prices. The market's focus on these less optimistic projections led to analyst downgrades and target price reductions. Several financial analysts, including those from Wells Fargo & Company and the Goldman Sachs Group, reduced their target prices for SFM stock. As a result, the company's stock value plummeted by 52.97% over the past year, reflecting the significant decline in investor confidence. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company are multifaceted and influenced by various factors. On the growth side, market expansion through new store openings and remodels is a significant contributor, as seen with the planned 40-plus store openings for fiscal 2026. Customer engagement and personalization initiatives, such as loyalty programs and digital connections, also play a crucial role in driving revenue. The company's advantaged supply chain model, which includes self-distribution of meat and seafood and fresh distribution centers within 250 miles of stores, enables efficient operations and supports growth. Additionally, the high sales mix of perishable products, 57% of sales, and the introduction of new products, 7,000 plus in 2025, contribute to revenue growth. On the other hand, store closures and reduced sales due to smaller store sizes are primary drivers of revenue decline. The decline of CBD products due to federal regulations limiting THC content is also a significant factor. However, certain aspects of the company's operations remain stable, including the consistent perishable and non-perishable sales mix over the past 3 years. Overall, the company's ability to adapt to changing market conditions, innovate its product offerings, and expand its market presence will be crucial in driving revenue growth or mitigating decline. The net income of the company underwent significant fluctuations over the years. Initially, it decreased due to various reasons such as general economic conditions, increased competition, and negative publicity over product safety. However, the trend reversed with a notable increase of $1.56 per diluted share in fiscal 2025 compared to the previous year. Furthermore, net income saw an impressive growth of 38% from fiscal 2024 to fiscal 2025. On the other hand, profit margins experienced a decline due to factors such as food inflation, reduced consumer spending, and competition leading to lower prices. However, there was a slight improvement in operating profit margin, which increased from 6.5% in fiscal 2024 to 7.8% in fiscal 2025. The gross profit margin, however, saw a decrease from 38.1% in fiscal 2024 to 38.8% in fiscal 2025. The reasons behind these changes were largely driven by external factors such as general economic conditions, inflation, and competition. Additionally, supply chain disruptions due to weather events, animal disease outbreaks, and other catastrophic occurrences also had a significant impact on the company's profitability. The company's financial performance is a testament to its ability to generate positive operating cash flow. As evident from the provided summary, the company has consistently demonstrated a strong capacity for generating operating cash flow. One of the key indicators of this success is the significant amount of operating cash flow generated in fiscal 2025, which stands at $715,998,000. This substantial figure not only underscores the company's financial health, but also its ability to meet its capital expenditure needs without relying on external funding sources. Furthermore, the company has explicitly stated its intention to fund its capital expenditures using cash on hand and cash generated from operating activities. This approach not only ensures that the company remains financially disciplined, but also reinforces its commitment to generating positive operating cash flow. The year ended December 28, 2025, report also highlights the company's ability to generate a substantial amount of operating cash flow, which is $715,998. Additionally, the operating cash flow, excluding leases, indicator confirms that the company is indeed generating positive operating cash flow. In conclusion, based on the provided summary, it is clear that the company is successfully generating positive operating cash flow, which is a critical component of its financial performance and sustainability. The company's debt level and interest expenses have undergone significant changes in recent years. A notable increase in long-term debt is observed, with a jump from $7,248 to $81,585 on page 58, indicating a substantial rise of over $74 million. However, another instance shows a more moderate increase from $7,248 to $12,165 on page 75. In contrast, interest expenses have shown mixed trends. On one hand, there is a decrease of $3,199 observed between 2024 and 2025 on page 64, suggesting a reduction in financial burden. On the other hand, an increase of $196 million in interest expenses from 2024 to 2025 is noted on page 74, indicating a significant rise in financial obligations. These contrasting trends highlight the complexity of the company's financial situation and the need for closer examination. Management is optimistic about the company's outlook and strategy, highlighting several key areas for growth. The long-term plan focuses on targeting innovative products and providing an exceptional in-store experience for health enthusiasts and selective shoppers. To achieve this, the company will expand its store presence by opening over 40 new locations annually, with a focus on high-concentration markets like California and Texas. The company is also investing in creating an advantaged supply chain through self-distribution models for meat and seafood, as well as expanding its distribution center network to support growth. Additionally, management is prioritizing customer engagement through data analytics, loyalty programs, and personalized content, with a focus on enhancing the overall customer experience. In terms of technology and efficiency, the company is investing in emerging technologies like artificial intelligence, machine learning, and cloud computing to drive scalability and improve operational efficiency. Financially, management expects significant growth, including an increase in gross profit driven by higher sales volume, solidifying the company's position for long-term success. The company has made a notable acquisition through the transfer of federal tax credits worth $63.8 million under the Inflation Reduction Act. This transaction is recorded on page 84 of the document, marking one instance where an acquisition was explicitly mentioned. The specifics of this deal are not elaborated upon in the provided summary, but it represents a significant financial commitment by the company to acquire these tax credits. The company's recent financial activities have been notable for one significant action: share buybacks. According to official records, a substantial number of shares were purchased, totaling 963,941 units with an approximate value of $1.842 billion. This move indicates that the company has chosen to invest in itself by reducing its outstanding share count rather than distributing profits through dividends. Concerns have been raised regarding inventory buildup and supply chain disruption in various sections of the report. On page 16, both inventory buildup and supply chain disruption were identified as concerns. Similarly, on page 22, inventory buildup was noted as a concern, but no relevant information was found regarding supply chain disruption. Further analysis reveals potential issues with inventory levels. For instance, on page 47, it is reported that inventory increased by $63.6 million due to improved on-shelf availability in certain departments. This could indicate a risk of inventory buildup. Additionally, on page 71, the data shows an increase in inventory levels from $10,566 to $21,099 between 2024 and 2025, suggesting another potential concern about inventory buildup. While these concerns are not necessarily indicative of current or ongoing issues, they do highlight potential risks that the company may face in the future. That concludes the financial summary for Sprouts Farmers Market Inc. Feel free to comment below, and I will be happy to answer them when possible.